Depends how they answer the phone, how they treat customers when they come in, how the orders are filled and gotten out, whether they go out on time or not. A business can be highly profitable and still not be able to pay its bills, or purchase its assets, or pay dividends to shareholders, and it can go bankrupt. You can have a great amount of profit. If you've got no cash flow, you can end up bankrupt or going into liquidation if you're a company. So how can this be? I'm going to ask you 3 key questions here. And I'll be interested to find out the answers to those once I've asked them. So, does anybody know what your current cash balance is? Don't answer that. I'll ask you the 3 questions. Do you know where to find it? And do you know what your cash balance will be in 6 months' time? I'll give you a couple of seconds to think about it. So, who answered yes to all 3?
Go to the account and
No? Who answered yes to 2? Okay. Who answered yes to 1? Okay. Got a little bit of work to do around the room, haven't we? Okay. To know what your cash balance is in 6 months' time, you obviously need to do some forward planning. And your bank balance is an outcome of the cash transactions that go through your business. It is basically the scorecard. Okay? What you've got in your bank is just the end result of all those cash transactions that have gone through your business. So where do you get your cash balance from? Anybody like to offer an idea where you get your cash balance from? Having destroyed your thoughts of going to the bank statement? Yes. Providing you're doing that, yes, you got it right, and providing you do it every day. So that's the best place to go. Because cash is not just what you've got showing on your bank statement, assuming it's not in debit. So cash flow, what is it and how does it work? So where does your cash come from? Okay, that is what we call the cash conversion cycle. It's the time between when we pay for our inventory and the time we get paid. Okay, it's essentially your accounts receivable plus your inventory days minus your accounts payable days. So let's use an example. Let's say we've done some sales, we've got some money in accounts receivable, we collect the cash, then we come down here, we obviously need to replace the inventory that we sold when we sold it over here to get the accounts receivable. We also need to pay the team, whether they be in the manufacturer or in the sales department, and the cycle goes around again. Okay? But this time round, instead of using all the cash to pay for inventory labour, we've got to put some aside to pay for assets, plant and equipment, pay our taxes, and also to create profits so that we can create wealth for ourselves. So the key drivers of cash flow are price. You can always adjust your price up or down. Volume, that's the amount of turnover that you have, or the numbers that are going through. You can have high turnover and low price, or you can have a high price and low turnover. You can have both, high price and high turnover, it's even better. Accounts receivable, if you haven't got a good collection policy in place, that's going to impact on your cash flow. Stock turnover, if you've got stock sitting on the shelf for 3 or 4 years, it's not good. You need to turn that into cash. In $100,000 worth of stock on the shelf is no good to you. If you can't sell it, you're better off having $40,000 in your bank account. At least you can do something with it. And accounts payable, obviously that impacts on your cash as well. So there are 8 common mistakes that business owners have in dealing with their cash flow. One is that they fly by the seat of their pants. In other words, they generally don't have a very good bookkeeping or accounting system in place. Or if they do, they don't do it regularly. They might only do it once a month or once every quarter. It really does need to be done every day. They don't know the numbers. Now, if you haven't got your bookkeeping in order and you haven't got all your numbers in there, how do you know how much cash you've got? How do you know whether you can buy that piece of plant and equipment or hire that new team member? Most of them don't know or ignore the relationship between receivables and payables. Obviously, you can't pay your purchases until you get money in from your accounts receivable, so there's a synergy there. So they've got to be in sync with each other.